Good morning, good evening, good afternoon, wherever you are in the world. Welcome to Beyond Bitcoin, a show about so much more than what is Bitcoin, often considered the focus of this particular space. My name is Derek Graham. I'm the CEO of Portal Asset Management, who is the manager of the Portal Digital Fund. Hey, look, just for one moment, I've got to boast about something, and that is that the Portal Digital Fund has been ranked #1 in Asia Pacific by Preqin Fund. And that's a large platform that analyzes funds, and it's the #1 fund of hedge funds for its first half performance. Okay, that's out of the way. And so now I want to introduce my friend and colleague, Nitin Gower, who's the director of IBM Financial Services and Digital Assets. Hi, Nitin.
Hey, Derek. Glad to be here, and another exciting week as it is. There's never a dull moment in crypto and blockchain space. Looking forward to another amazing conversation.
Terrific. Well, look, hey, I'm so excited about today's conversation because it's the essence of what blockchain and what Satoshi Nakamoto was intending to create, which is this freedom of the economies, this democratization of assets, this taking out the middle rent taker on the way through. And so we're coming from this from a week of interesting reading. So this week, you and I have read about the 3Ps, the Panama Papers, the Panama, Pandora, and Paradise Papers. A great discussion by Natasha Che, who's a macroeconomic specialist, and views about the historic shift of wealth and how this shift can benefit the middle class and the current level of cryptocurrency ownership around the world. And so with that in mind, let's just say this, and that is, don't forget to subscribe and follow if you enjoy our conversations. We're on YouTube and, of course, on the podcasts. And Nitin Gower and Derek Graham, DRYCK, is on LinkedIn, and you're welcome to follow or communicate with us through there too. So you might remember that last week we started with the cover of The Economist that said, "Down the rabbit hole, the promise and the perils of decentralized finance." We started with that because we wanted to note that the world's economists, the world's governments, the world's leaders knew about this space. It was no longer secret. And what I want to take from here is the fact that this space is the wholesale democratization of investment. And I might go through just some of the democratization that we already know that exists. So, by example, the financial payment systems, when we see things like payments from person to person, neighbors to neighbors across the world, across the country, but payments from people like Philippine maids in Singapore, across to their mothers back in the Philippines, no longer having to use the likes of Western Unions and their extraordinary usury rates that they would otherwise charge. The lending and borrowing world, when you can see lending and borrowing occur on Aave, on DAO, on Compound. And by the way, you can find all of these things on defirate.com to see more about the lending and borrowing environment. Social networks via NFTs. We talked about it before, where artists were actually able to connect with their followers in a way they've never done before. They no longer have art studios or production houses sitting in between them and their followers. They can actually communicate and have a society built around them. And we think that's extraordinary because it's a classic example of bringing together of society through these tokens, in this case, non-fungible tokens. Investment in assets using NFTs, whether they happen to be digital handbags or crypto kitties, or office towers and listed stocks. And you can see a lot of that on OpenSea.io. And even the play to earn gaming environment, which we can hear storming over the hill as this asset class comes towards us. What we're seeing there is historically different ways of investing, and frankly, just the beginning. But we wanted to put this today into context and see whether this is really happening. And so one way of doing that is starting to talk about a little bit about Natasha Che, who's a PhD in macroeconomics, as mentioned. You can follow her at real Natasha Che, CHE at the end, on Twitter. And she talks about, and I'm sorry, I'm going to read a little bit if that's okay, that rising inequality is an inevitable feature of capitalism. But like all systematic shocks through history, the rise of crypto will help reset wealth distribution. That's what I'm particularly interested in about today. So wealth inequality is at its highest in US history. It causes social upheaval, which we've seen, and it's bad for the economy. And the reason why, of course, is that it's creating weak purchasing power of the middle class. The demand drive drops away. Crypto is a shock to the status quo because it creates new types of assets that have better features than many of the existing assets. This won't change anything at the top of the income distribution. The wealth can still buy whatever assets they want, but it will level up the bottom, more capital ownership at lower income tiers, and help reduce overall inequality. But crypto changes that pattern, and here's why. When the economy goes through a paradigm shift, the embodiment of capital changes. This is great. This is historic context. And she's saying in the 18th century, landed gentry, such as Mr. Darcy and Jane Eyre's novels, generated their returns out of farmland. In the 19th century, capital was generated out of factories and machines and government bonds. In the 20th century, capital's been generated out of urban real estate and equities and stocks. During such a shift, the rich from the old paradigm lose out because the asset classes which their wealth was denominated in either gets destroyed or plummets in value. This is, in fact, the primary way that capitalistic economy resets wealth distribution through massive creative destruction of asset classes. Without such disruption, existing wealth will grow more concentrated in fewer hands over time for reasons we talked about. A similar history is starting to play out today, and it will continue for years to come as the crypto asset class grows. We'll look back and realize that we are in the 20th century of digital assets. So Nitin, are we hypothesizing about this, maybe become too euphoric, or are we really seeing a global movement in this direction?
No, Derek, I would agree with Natasha's assertions, and I'll tell you that many of us who got into the space, this was one of the primary reasons that we got into it. When I looked into researching blockchain and Bitcoin in 2012, it clicked to me, and I'll give you a few evidences where this is something which we have talked about in economic circles. We've talked about the potential of technology per se. Is I moved to the United States when I was 19 for education. And the reason for that was because of the access to information, access to education, which sort of lets you learn new things and uplift economically, socially, and an ability to be able to do things. And then came about internet. And over time, we begin to exchange information around the globe. The protocol evolved, the standards evolved. And as these standards and information speeds accelerated, so did the ability for us to collaborate. And then came sort of the underutilized economy where we could start doing Uber and other elements of having virtual assistants. And we began to sort of utilize this underutilized capacity that was trapped, whether it's in the same country or looked into finding the best talent, because no longer location and geography was an issue.
Yes.
And we have now moved from the entire digitalization space to tokenization space, where we begin to look into the fact that I can now begin to tokenize various things of value, which was enabled by this information economy to, again, unlock a massive potential, whether it's unlock potential of locked capital, because capital is locked along the way, or ability to be able to create a singular sort of investment platform that opens up to the world. And my vision when I got into the space was the fact that if we build a protocol, just like we have internet, is ability to consume information and misinformation, which is the problem of the times, has really become equal. That the same information is available to a farmer and a village in Uganda, a village in India, and that has uplifted ability for them to learn and know new things and make changes and in life. And the whole idea is if we can build a protocol that allows the same people to make choices in terms of savings and investments, taking advantage of the growth patterns and growth potential of these ecosystems, I think that enables a whole new set of economic principles. So the way I divide this into, which is what I think Natasha was referring to, is element of economic inclusion, which is including the 1.6 billion people, and I'll throw some stats as I learned in preparation for this call, is the close to about 1.6 billion people who are either unbanked or underbanked in the world, which is still close to about 20% of the global population, which is still a big number in this day and age. But there's also an element of democratization of the level playing field. So a few numbers before we go deeper into the conversation. Some countries, if you look at top 5 countries, it's India, it's 100 million people who are, and this is from AAA, triple-a.io, and Chain Analysis, which do constant sort of look up into what is the global participation in that entire ecosystem. And there's hardly any country that's not on the list. It's pretty much, there's some small percentage and some large percentages participation from every single country on this planet, which to me is credit to the internet. It's credit to ability for people to know and learn and be able to be on board with these platforms pretty, fairly quickly. So India, 100 million people, USA, which is where I live, 27 million people. Nigeria is 13 million people. Vietnam is 5 million, and UK is about 3.3 million. And if you look at the mix of some of these countries, two types of countries pop out. One is access, sort of the ability for people to access these digital platforms fairly easily. They have a little bit of excess wealth, a little bit of disposable income for them to be able to get their feet wet with investment. But then there's another class of countries which is purely out of necessity. I mean, there was a stat where 79 million of Indians have gotten onto this platform from tier 1, tier 2 cities. Entire Vietnam has taken advantage of Axie Infinity. So there's stats after stats that indicates that there are a whole second sort of set of countries who are purely doing this as a necessity, either for economic upliftment or being able to sort of embark on this ability to either create a secondary income or have the hopes of making it rich, which I think is an important aspiration that we have to keep in mind. So I'll start with that. I'd love to get your thoughts on some of these things.
Well, one of the things that we talked about a couple of episodes ago was the distribution of true utilization of digital assets and currencies. So we know that we speculate in them because what's happening at the moment is the developed countries are building out the infrastructure, the platforms, the lending systems, the exchanges. That's all getting built out by the developed countries. The users are the developing countries. And we're seeing the likes of Vietnam as the top of the user base, and in the top 20, you recall that Afghanistan was it was number 20 in the user base. And so we're seeing this extraordinary thing where developed countries are saying, we're building it, and developing countries are saying, we're using it. And so we might see that classic technology jump where the developed countries, in some cases, just simply jump the existing systems. They leave the infrastructure, they leave the banking systems, and they go straight across to these new technologies. Another opportunity to democratize the world and democratize and break down the world's current control of assets and payment systems. Are you seeing that in your statistics? Because I know you did some research on the sort of the numbers that were getting used, the number of people that are utilizing cryptocurrency or hold it in different countries.
Yeah. So let me give an example of two things, right? One is two elements. And this is, again, addressing the economic inclusion part of this conversation, where you have a traditional, like a UN entity called UN Innovation Fund. And this is a crypto fund that's pooled fund of Bitcoin and Ether. And get this, this is a world body. And a part of UNICEF Innovation Fund, which is this UN fund, with the distinction that investments made through crypto funds are denominated in crypto. So this is an arm that's looking into understand this crypto space, but also sharing that with the public records of crypto transfers, because UNICEF and UN do have to move their funds for purposes of making payments. And so they are using this fund as a guinea pig to be able to see how can they move the funds. But they're adding a layer of transparent accounting to donations and investment processes. And the crypto fund is a prototype fund for UNICEF to explore the use of digital currencies and what it means to operate. And they have funded globally around 10 or 15 really cool projects. Some of them are most of them are in Kenya, India, really focusing towards developing decentralized applications. And as you mentioned, the on-ramp to the global sort of the developed world, building these applications, but developing world on-ramping to these and taking advantage of it. So this is a UN global body doing it.
Wow.
Then there's
And
another
they're using
project I'd
digital
like to talk
assets
about.
and digital currencies to do it. And that
using
means all the
digital
way
assets. In
down to
fact,
the level, I'm assuming, of micro lending and things like that at the other end of the chain.
there is micro lending, there's payments, their ability for them to be able to track and trace the activities that happen for the purposes of donations and the purposes of tracking donations, and including, get this, including investments they have made into, I think, the 10 companies, and I have some names, X Capit in Argentina, Grassroot Economics in Kenya, Somish Blockchain in India, there's BX Smart Labs in India, and all these in Mexico. They're also funded by crypto. So it's sort of like a VC arm, which is using crypto funds to fund these companies, so they can drink the same champagne, so to speak, to build these things.
Hey, but the other interesting thing is that often in really dire straight situations where a country is at war, or there's a base belief system that is very against the belief system of incoming NGOs to try and help, they'll steal their money. They'll stop the money coming through. They'll stop the activities occurring. Well, it makes it very hard for them to do that if it's in a digital economy. Yes,
that's right. It's like stealing a Bitcoin ADM, hoping to get money from it. And well, we know how that turned out for many of the early days funny stories. But you're absolutely right, Derek, because there is a project in Iran, which, as you know, is heavily sanctioned, and for humanitarian purposes. There are some allowable transactions, whether it's food or medicine. But there's a project called 3JAR, which is an open protocol that connects the tree funders to rural planters. And so this is, imagine Iran, and this project is trying to figure out an economic system to be able to make the planet greener, which is transcends all the political and all the sanction boundaries and all the political agendas that go with it. But there's, in the same theme, there is a company called Cello, and Cello is a coin, Cello is a token.
Yes.
And Cello essentially is built around mobile economy. This is about incentive economic tied to a wallet that you carry and use the same token to be able to make micropayments. Again, a very economic inclusion agenda, and they have partnered with many telcos. This is, to me, an extension of what M-Pesa was back in the day with a twist, with the blockchain twist. And they formed something called Alliance for Prosperity. Now, Alliance for Prosperity is a group of today more than 100 key players, which is all blockchain companies. Some of the notable entities and the backers are Anderson Horowitz, Coinbase Ventures, Cello, Zilliqa, and there are like 100 very well-known names. And their entire goal of this Alliance for Prosperity is to create an environment for innovative financial services application to thrive. So you started out this whole conversation with economic inclusion. You talked about Natasha's whole element. And I think what Cello and Alliance for Prosperity and some of the UN projects that we talked about, they're building that infrastructure. They're building the ability for us to have a trust relay protocols, which if I'm in Kenya and I want to make an investment, then one of the maybe UN funded projects in Kenya, let's say Kotani Pay, which is again, a UN funded project, maybe connects to Alliance for Prosperity. And it's able to then truly enable, facilitate global movement of tokens, whether the token happens to be a payment instrument or the token happens to be a securities, a tokenized security, maybe investing into companies like IBM or fractionalized security like Tesla, and taking advantage of the economic growth that many of these blue chip companies represent, which, as me and you both know, you living in Australia and me living in the United States, is only affordable to a few, only because we have access to these markets. So I think you're absolutely right. I think that's where we're heading with this. I'll take a pause at that. I'd love to get your perspective, both in terms of the element of, are we really heading in democratization, which is the intent? Because you begin to now see a lot of VC firms coming into the space. You begin to see many of these blockchain firms are consortiums, and they have founders and they are raising funds through traditional VC. And sometimes I fear that Satoshi's original vision around truly, equalizing that through Bitcoin is still not fully fulfilled while you have all these goodness and all the projects, because now you begin to see private equity and private capital coming into the space, creating the same moats that they have done for ages with traditional finance.
Look, you're absolutely right. So this is the argument of the Bitcoin maximalists that think that Bitcoin is the most pure thing that there is out there, and that's wonderful. But our view here is that Bitcoin represents a part of the DLT and the digital economy, really, and just like gold would in a normal economy. And so if you look at this, I think the entry into this space and the offerings in this space are digital offerings. They are, at the end of the day, a potpourri pot of different types of digital offerings, some of which are centralized, some of which are decentralized, some of which are promoted by promoters, and some of which are built by communities. And I don't think that's going to change. We know that in many cases, the DAO, the decentralized autonomous organizations, can operate so efficiently that it's very hard for a centralized organization to compete. So we might see economics take some of these central organizations out along the way, and that'll be the outcome of it. But I don't think for a moment that we can sit on a high horse and say that centralized offerings don't play a role in this space, and that large VCs, and I'm not a huge fond follower of VCs, having dealt with them in the past, but large VCs don't play a role here too. They do. They create the products that are going to come through the pipeline over the next 12, 18 months that we're all going to be able to invest in. So they certainly play a role in all of this. And so the other thing that's interesting is the fact that these things don't get created in absentia, and they didn't get created yesterday or the day before. Although this space moves really fast, there's a whole section, kind of a confluence of conditions that have occurred for these decentralized working spaces, economies, and currencies to exist. So, COVID-19 came, for crying out loud. Fancy a show not actually mentioning COVID-19. It's the first time I've mentioned it for a while. COVID-19 came along, and everyone had to go home and work from home. We are heading towards what I'm fascinated to see what might happen, which is the great resignation that they're talking about. And that is that they expect in America alone, 2 or 3 million people just won't go back to work. They're going to go, that's not my lifestyle. And I don't want to be that any longer. And so from my virtual assistant, Vivian, who operates out of the Philippines, to a person that's a very high-end executive that operates out of their home, maybe in the countryside in Wisconsin, decentralization is occurring with them. Yeah. And that also means that the centralized cost of real estate in some of these big cities can start dropping back to a more reasonable level, because people are going, I don't need to be in New York. What am I doing here? I'm going to go to the countryside because I can operate from there. Well, how are they going to operate ultimately? Using digital currencies. How are they getting paid? With digital currencies. What space might they be in? They could be in traditional or in digital currencies. So the natural movement that's getting facilitated through the internet, and now the internet of value, being cryptocurrencies, has been energized by COVID-19, whether you happen to be in the Philippines or whether you happen to be in New York City. And so I think that's going to also put digital assets on steroids.
No. So let me unpack that a little bit, Derek, because I think what you mentioned was super interesting, because economic inclusion and democratization of finance is not just an issue. We always bring the emerging economies. I always give example of Uganda and India and Vietnam. But I would like to actually bring back United States into focus, because as you rightly mentioned, we've had a significant decline in that disparity between rich and poor over the years. And we have seen, again, not just emergence of DeFi, but also the great resignation, as you mentioned, which I think is an interesting term, is because they found other avenues to monetize their talents and found avenues to provide flexibility in their life and truly work in a decentralized fashion. Because I think they have, while being locked up for 18 months, they have explored that avenue to say, I could do all these things and not have to be tied to my 9-to-5 job and make the same amount of money, because decentralized sort of economies, which has created new skill sets. So we have people who have embarked on new skill set. They have new trading skills, and you don't have to necessarily go and be sponsored by a financial institution to get a Series 6, because you could understand the economic system and be a trader. And that's why the question of the notion of a accredited investor, which has come up a lot lately, is why is that a requirement as a participation into some of these systems, and why is regulation still on the side of the rich and of the wealthy, while the decentralized economy has proven otherwise, that the same level of risk that's taken by the rich are taken by the folks who understand the system. So the knowledge gap between the various financial systems has been closed. So I think that's a really important observation. I'll say one more thing before I get your opinion on these things is it's not just crypto in the sense that you have pure crypto native assets, which is the entire newly created DeFi economy, Ethereum, Bitcoin, and all the ERC20 tokens and the 12,000 plus different tokens that are in mainstream today. But you also have ATSs, which is alternate trading systems, not exactly mainstream exchanges, but these trading systems have gone and embarked on issuing security tokens, which is going after corporate bonds and equities and swaps and ETFs and commodities and derivatives, going after ABSs, which is non-traditional sort of finance, and going after taking the private equity, tokenizing it, and creating liquidity in a very illiquid market simply by opening up larger markets, inducing liquidity, and going after secondary markets that simply had not existed until now. So me and you could go and be in financing a road or a One Belt, One Road initiative in parts of China if this was possible, by investing into a token, for instance, or investing into a road or infrastructure projects in Minneapolis and Minnesota, which early on, I don't think me and you could have access to it. Yes. But because these systems are emerging and they're tokenizing not just the DeFi and crypto space, but looking into applying the same tech, I think that has a massive potential to opening this entire space up for, again, the masses. So I just want to get to see if you're seeing the same vantage point from the old and the new, and eventually converging into sort of similar asset classes or providing an array of asset classes that gives us a choice.
Well, exactly. It's the fractionation and the democratization and the digitization. All of those things is what is bringing both traditional environments together with non-traditional environments. So by example, if you were immersed in this world and you enjoyed the world of Superworld, by example, who we've had the nice CEO on our webcasts along the way, you would be dealing in clothes, luxury items in a digital world, non-fungible tokens that are just odd assets. Now, those assets just didn't exist a decade ago. And so that is an asset class. So when people from the traditional asset world look at this space, they look at the space and they go, so how can my stock be digitized into this space? Well, it damn well can, and it'll be extraordinary. And we'll talk about that in a second. But the point is that the digitization of traditional assets and the creation of new digital assets will sit side by side with each other in this space. And it won't just be old assets getting digitized to new. It'll be totally new service provisions and assets and solutions unthought of before that are digitized because they're in a digital environment. And so if we talk for a moment just about the potential of digitizing stock, could you imagine for a moment the stock that we have? Right now, we've got stock. We don't see the certificate anymore. No. You get stock transferred to you and out, and that stock gives you a dividend right, and it gives you a right to vote and the ability to do the transfer of the stock. That's it. In fact, if you looked at it from a smart contract point of view, it would be dumb. And so if you were to look at what a stock could be, you could actually put a smart contract with a stock. It could account for so many different layers of shareholding classes and voting classes easily, but it also could do this. And that is, if you had stock in a particular hardware outlet or a particular chemist or and you went with your digital and you bought that, and it's noted constantly every time you buy something, you could be credited with some more stock. Yeah. You could be credited with options. You could be part of that company in a way impossible beforehand. So not only are there two asset classes here with traditional assets and totally new assets, it's this confluence that sits in between where traditional assets can become so much more than they are now if they're able to be digitized. And that amazing power that is able to be given to the companies, I think, in fact, I kind of hope, that we'll see the likes of the Australian Securities Exchange, NASDAQ, et cetera, which are centralized silos that are hard to invest in anywhere else in the world unless you've got special accounts or a Bloomberg account. I hope we'll see many of those companies, of which there are 620,000 of by memory worldwide listed public companies, take the route of saying, yeah, okay, we'll be listed, but we're also going to release a digital asset. And that will again get to a point where people can fractionate that digital asset and spread it all around the world. But one of the things you mentioned there was accredited investors. This really gets me annoyed, because what's happening with this is we're seeing the Securities Exchange Act of 1934. Do you get that number? 1934, which was created to govern security transactions on the secondary market of the world in 1934. And these people, through Gary Gensler and the SEC, and after all, this is all they've got to work with at the moment, so they're police officers and this is the law, these people are looking at digital assets that we've just explained are many and varied across the world and type. And they're looking at these digital assets and saying, well, I think they're securities according to the 1934 Securities Act. The problem here is not the Securities Act. Sorry, it is the Securities Act. The problem is the Securities Act is not relevant to this asset class. Not that this asset class, in fact, doesn't fit the Securities Act. And so what we see there is we see the likes of Gary Gensler, who turns around and makes comments like, well, I'm not going to have people lose money, investors lose money, retail investors lose money on his shift. I'm sorry, I'm just going to get a little grumpy here. But while Gary's shift is operating, the famous 3 Ps are in place. The Panamania Papers, which are 11.3 million documents and 214,000 offshore entities. The Paradise Papers, which are 13.4 million documents, 125,000 operating companies across 19 jurisdictions. And the Pandora Papers, which are 12 million documents. So this is a total of 36 million documents have been revealed. Blessed are the International Consortium of Investigative Journalists who have done this. And they're showing where hidden wealth is, tax avoidance is, and in some cases, money laundering by the world's rich. There's more than $11.3 trillion of money hidden away. And Gary Gensler is worried about $2 trillion that maybe retail investors might lose some money upon. What I think here is that, in fact, cryptocurrency is not a place for transferring drugs or tax avoidance. It's really a place for the medium class, the middle class, the individual retail investors to be able to invest and get exponential growth as this industry starts taking over all the traditional industry ways of doing transactions. It is, in fact, the absolute reason why we should see retail investors being able to invest in this. Yet he's sitting there making the statement, hey, we might not want retail investors in this space. This should really be left for the grown-ups, the accredited investors. Do you think he's going to get away with it, Nitin?
Well, I see hope in that. And I think, like all the ICIJ, and I've been a huge fan since Panama Papers, and I've actually read the Panama Papers. I read the Paradise Papers. I have not yet gone after the Pandora's Papers, but in the same theme, I think there was an assertion that was made by one of the authors or one of the ICIJ members that many of these shell companies in the structure, again, under the Securities and Exchange Commission supervision, had created a structure that actually impedes the economic growth and hurts the economy, and it's corruption at a much larger scale. And we begin to look at that with regulating things like stablecoin instead of understanding the strengths and merits of technology. And yes, we do need investor protection in every facet. That includes the facets that you talked about, right? All that has been exposed by ICIJ. I think is very profound, and I think the overall restrictions, and there's a hope here, right? The overall restrictions on retail investors to invest in private assets and leftover from the pre-internet, pre-digital era, they don't make sense anymore. They discriminate in the sense that,
Yes.
like we have really smart people coming out of college, brilliant. They don't have to have, a paycheck of $300,000 a year or have $2 million in their account to be able
Yes.
to be smart and be professional about it.
Correct.
Are unfair and have negative effect on the economy, because now you're sort of barring the people to say, hey, you have the ability to take risk, instead of focusing on creating systems that allows them to be able to, invest wisely and understand the risk that goes with it. So we have tool to provide these investors with more financial freedom, better financial opportunities, and digital assets and cryptocurrencies provide that transparency and protection that people like Gary Gensler and many regulators in the same shoes are trying to address. So something happened today, just a few hours before that. Regulatory Asset Management Advisory Committee. This is a committee that sort of, they don't change the laws, but they advise the regulators, backs, easing access to private funds for retail investors. And I think that hopefully should, indicate to the lawmakers and regulators to loosen the access and open it up. But loosening access versus true democratization, which is what we're talking about here, are two different things.
Yes.
So lowering the barriers still is discriminatory, still is unfair, whereas allowing people to be able to provide the right set of guidance and rules and allowing them to participate, I think is more profound from a perspective of what the industry is trying to do. So I think a lot to be, unpacked there, I think. But I agree with you, Derek. I think that the damage that many of this notion of cascading shell companies and creating Russian dollar shell companies to structure a movement of money and to be able to embed them into economic system is classic definition of money laundering. Yes. And that's exactly what's happening here. And that should be in check, because that's essentially taking away from taxes. And as much as we all hate taxes, they have a role to play in our society. And that's essentially what Panama Papers talked about. So I couldn't agree with you more, I think.
So here's a call out to Gary Gensler. Gary Gensler, aisle 3 is looking messy. And it's looking messy because there's $11.3 trillion worth of money getting hidden, laundered, and put away. Maybe you should look at tidying that aisle up and let cryptocurrency grow and retail investors be able to get access to it. I mean, we at Portal Asset Management find this very frustrating. So we have an institutional grade fund which has administrators, auditors, fund managers, all running to an institutional grade standard like any other big fund. But the investors have to be wholesale, accredited, or sophisticated, depending on which nation you come from. Broadly, $250,000, $300,000 income and $2 million investment. Why? They're returning at the moment through their superannuations. It's been a good year for the last year, but normally they're returning 8% maybe if it's a really good superannuation fund. The self-managed super funds that are out there, they should be able to have access to funds like ours that give them far higher returns than their 8% per annum at best. And this is because there's a set of regulations there that goes, no, not for you. This is for the wealthy and the sophisticated. And I feel that is so wrong. Anyway, I'll get off that horse. But I feel that is so wrong that people aren't able to see real growth in their assets. And of course, if nothing breaks that down, like the breakdown that you're going to see in this shift of technology, then the gap just gets greater and greater through compound interest. So someone's got $10 million, you'll never catch up with them if you've got 100,000. And so this is that breakdown that can occur. And interesting enough, we're allowed to go to casinos and blow our entire fortune, everything, no trouble at all, endorsed. But when it comes to knowledgeable,
it's gamblers, it's investor protection, not gamblers protection, Derek.
Yeah, that's true. That's exactly right. But we mustn't forget that Gen X, Y, and Z are highly educated. They're the largest demographics in our demographic flow, and they understand this space because they're digital natives. Those people should get this right to be able to not just become wealthy in their own right, to be able to buy houses that they can't currently afford, to be able to live anywhere in the world that they want. And this space of digital assets and distributed ledger technology enables that to occur for them. And That's exciting for that generation. What I also feel is exciting is it's exciting to think that someone in a village in India or Uganda can make an investment in a developed country that's returning a very high rate in a stable environment without sovereign risk or without political fear. And they can do that using digital assets. It's a far cry from the rubbish that we hear about Bitcoin and drugs, isn't it?
True. No, absolutely. And I'll say one funny story, Derek, before we wrap up, because I think we're coming up with time.
Yeah.
There's something called securities lending, which is only afforded to hedge fund managers, which basically, do a shorting of stocks and be able to borrow stocks because you cannot sell what you don't have. And there's a cost associated with it. And a lot of custody banks and make a lot of money from it. They finally decided to open that up for some asset classes. And I experiment a lot, as you know, with different trusts. And I have Bitwise 10, which is one of the funds that looks into top 10 just to be able to see what things are. And my investment bank, who shall remain unnamed, said that, out of all the asset classes you have, that's the only one that you can do with securities lending. I can lend that for a fee, which is all the things that you're talking about, is the newer business models, ability for me to be able to lend and protocol managed sort of transactions. And guess what? For me to lend my digital asset, a trust of digital assets, they send me 5 documents that I had to print, sign, scan, and fax it before they could even give me the return. And I'm like, really? I mean, the irony of all ironies is that for you to be able to lend your digital asset, because they've been now offering from a lot of these investment banks as a part of your portfolio to get exposure. Now I have to do this traditional way of providing consent. And I'm thinking, why don't we get onto the digital bandwagon and start with digital signature? Forget about crypto. That's too complicated for many of these. Let's just start with digital interaction before we get to that level. So I thought that was really funny. And that made my day today, actually.
Yeah, it is really funny. And trying to explain it to them, I've often found that they give you a very blank look on their face going, why not? But there you go. And so look, we've had a meandering journey today, and I hope that the audience has enjoyed this as much as you and I have, Nitin, which is an opportunity to express our views and see the tectonic shift that is actually occurring in this space and feel part of it. Being invested in it, you feel part of it and you learn about how it operates. And so I hope that has helped some people on the way, inspire them maybe in regards to how charities can work. If they're running charities, and they might think about digital assets as part of that in regards to how they invest. And of course, we never give investment advice here. This is just a conversational environment, of course. But it's really, of course, worth learning about. Any comments or thoughts, you're welcome to share it with Nitin and I. And look forward to seeing you next week on Beyond Bitcoin. Bye for now.
Bye, guys.
Thanks, Nitin.